Lately, most of the news that I've seen about real estate has been the coming crash. Everybody seems to be talking about it. It's either that or the YouTube and Google algorithm just wants me to believe that there's a crash that's imminently coming. In this video, we will take a look if there is something to all this brouhaha about a real estate market crash. Hey guys, my name is Mac Rogers. I'm a real estate broker here in Castro Valley, California. Welcome to the channel. If you watch the channel or some of my videos, you know that I'm bullish with this real estate market that we have. So I won't go over the why it's not the same as the last time, meaning the crash of 2008. Instead, I want to go over signs that there may be cracks appearing on the horizon that may eventually lead to a market crash, a real estate market crash. I'm reminded by this Tony Robbins quote, "Where focus goes, energy flows." I feel like that we are talking ourselves into a real estate market crash that is out there just lurking in the background. Now, why are people saying this? You know, a market crash coming? Well, it's because prices have risen year over year at a pace that's well above the average. Home buyers are overpaying for their homes. In my market, 100,000, 200,000, 350,000, we just shrug it off as normal. And to some extent, here in the Bay Area, we've grown accustomed to all this bidding wars. In my almost 20 years of being a realtor, this has been the case in, I would say, probably 98% of the offers that I've written. There's always other competing offers. It's just now the numbers are bigger, and also it's happening nationwide. Back when I first started, $10,000, maybe $25,000 over, and it was more of a California phenomenon. Also back then, as a buyer, you still have the protection of your loan, appraisal, and other contingencies that you put on the contract. Now, here in the East Bay, if you put one minuscule contingency, your offer is rejected, which is fairly easy for sellers to do since they have buyers lined up waiting to buy their property. But everything must come to an end, right? And this is what these negative Nellies are basically banking on. And they're starting to look right. Well, maybe. Lately, the rate of home price growth has started to slow down and the competition for homes is slightly easing. According to Mark Zandi, chief economist at Moody's Analytics, the market's topping out and it's starting to show cracks. It feels like we've hit an apex and we're moving to the other side of it. I personally don't totally agree with this quote. I agree that maybe we're topping out. I see that in some neighborhoods all over the East Bay, but starting to show cracks, that implies that there's something wrong with the market. I've gone over this several times already. We are in this frenzy market because there's genuine demand from qualified buyers and not enough inventory to buy. That is why prices are getting pushed up. It's not like the last time where there was plenty of homes for sale and there were a lot of buyers that weren't qualified to buy. The question still remains, if we are at the apex, are we going to come crashing down? Well, no. That doesn't mean that the housing market is a bubble that's about to burst. Again, the buyers that are out there right now are all well-qualified buyers versus nearly a decade ago where anyone that was breathing can easily get a loan. In fact, mortgage lending has remained tight. I go back to my previous statement. Well-qualified buyers. The crack that he's probably referring to is not really a crack, but more of natural market forces. If you're at the top of the market, that means less and less people can afford to buy, which seems to be the case lately, but we don't have enough data yet. So, top of the market, less and less people buying, this should equate to price going down, right? In real estate or housing right now, the other side of this equation is inventory. It's not like there are less buyers out there and inventory is growing. On the contrary, it's actually still going down. Take for example a $1 million house in the East Bay. Nice sought after neighborhood. You have maybe 12 offers on the property. Only one gets it, right? You now have 11 other buyers out there that lost out. Say, out of 11, 6 of those buyers got either priced out of the neighborhood or just said, forget this, we give up. Now you're left with only 5 buyers looking into that same neighborhood, not taking into account new buyers coming in. Now another property comes on the market in that same neighborhood. Maybe these 5 buyers are not as aggressive as the one that got the other house. Maybe none of them go crazy like 20% over asking. So you start to see the slowdown. Because some buyers are getting priced out of the market, you will eventually run out of buyers that are always willing to pay 15 or 25% over the asking. What would be left are those buyers that wasn't bidding that high and kept losing. This scenario actually plays out. I've seen it before and I'm seeing it now. We still have a severe shortage of homes for sale. In fact, if you've watched my last video, the total housing inventory is down 42% year over year as of the last week, according to Realtor.com. The number of home sales have fallen not because for lack of demand, but lack of inventory. Existing home sales dropped 0.9% in May, month over month, the fourth consecutive month of decline, according to the National Association of Realtors. Now, here's one number that may be of a concern. The number of new mortgage applications for home purchases dropped 14.2% annually during the week ending June 18, according to the Mortgage Bankers Association. This could be nothing, simply a blip. After all, it was Father's Day weekend and then heading into the 4th of July right now. But it's definitely something to keep an eye out. What I tell my buyers is don't stop looking, because your competition sooner or later will get buyer fatigue. And this may be the case. Buyers still in the market may soon start to see fewer bidding wars and fewer offers that are way above the asking price. That's probably more true on a national level. Here in the Bay Area, still expect to pay a premium and still expect competition. According to Joel Kahn, an economist with the Mortgage Bankers Association, he believes that the number of purchase applications for mortgages will continue to rise this year, but he believes it will be mostly driven by higher-end buyers. This seems to be counterintuitive with what I'm seeing in the market that I serve. What I see is properties that are in the higher end or higher price relative to their market is beginning to show signs of weakness. So again, maybe on a national level, that could be true. Here's one thing that most economists are generally forecasting. That is an overall slowdown in price appreciation and not a major collapse or crash. Even at the sky-high prices, there are still plenty of potential home buyers that are eager to purchase. These are also driven by low mortgage rates. The continued lack of housing inventory will help soften any blow. Unless we see a glut of homes from home builders to meet demand, prices will remain resilient. One client asked me before if they overpaid for their house, to which my response was, absolutely. How else can you have won the bidding war if you didn't overpay? And in the short-term horizon, prices are still most likely going to hit record highs. If you're looking for deals, it's not happening, but competition might not be that fierce anymore. Momentum, again, seems to be slowing down a bit. So the battle cry of all these people that keep saying that we are headed for a crash has always been that prices are too high and people are overpaying, just like back in 2008. That is true, but there is one fundamental difference between 2008 and now. The buyers of today are not speculators. They are not buying houses left and right in the hopes that it goes up and then they turn around and sell it to the next person. Kind of like Dogecoin. So a housing crash is unlikely in our current scenario. It more likely will be a slowdown that could feel like a crash simply because we've gotten used to double-digit gains year over year. Home sellers that still have sky-high expectation will most likely be disappointed, and to them, it might as well be a crash. Our housing market won't crash because of prices too high. It won't crash because of another mortgage meltdown. It certainly won't crash because of supply. We have a shortage. I don't know what will make it crash. Maybe a huge blow to our economy and we see massive layoffs of employees with high-paying jobs, another pandemic lockdown, terrorist attack, civil unrest, stock market implosion, the eviction ban that the Supreme Court just ruled unconstitutional. It could be a combination of all those, or something we don't know. What do you guys think? Am I wrong? Am I too bullish? Love to read your comments below. Have a great day.